this is the second in the series. We thought that if people were interested in personally divesting, that it would be good to get some advice on that. Appreciate y'all showing up and agreeing to be on the panel and help educate us. I know I, as an individual investor, have got some very specific questions about how to go about doing it.
Jeff Waxman. I'm currently with Morgan Stanley as a family wealth director, having practiced investment and planning for over 20 years. I thought this was a great opportunity because I had historically have not dealt with socially responsible investing or impact investing or ESG investing to research, and I found it amazing some of the things that we're going to talk about here today, but as a chance to actually start to incorporate this in my practice. And so I practice wealth management for a wide variety of people who have a lot of different personal goals, and this should fit in pretty nicely.
Eric Packer, and I'm with Progressive Asset Management Group. And we were our own independent broker-dealer, one of the first major social responsible broker-dealers out of California, starting out in the late 80s. And we joined with a boutique firm out in California called Financial West Group. So we are now a division of a mid-sized broker-dealer. And I came to this, as many of you, as an activist from my days in college, my days in graduate school. I was trained by a Wall Street firm. I was trained by Prudential Securities. And after 3 years of traditional training, I realized where my values were, where my passion was. And I said, how can I incorporate that into investing? And then I learned of social investing, and if you all remember, South Africa was the big issue, and we were all talking about activism, shareholder activism leading to divestment. And so I'm going on my 21st year of being an investment advisor. We work out of Wellesley. Our client base is individuals, families. We work with some churches, nonprofits, small companies. And we're really committed to working with clients who want to have their values and their principles incorporated their investments. That also includes community investing. It's a very powerful way of giving back. And I'm proud to say that I've been very active with 350.org for the last almost 4 years, both nationally, Bill McKibben, Jay Cremota, working on the divestment campaign. And here in Massachusetts, there's a lot happening. It's wonderful. We're the most active state now in the country dealing with divestment. So I've been involved locally here on panels and working with 350 and helping to educate people about what divestment means, how it can make a difference, and how individual investors can incorporate it into their investment portfolios.
My name is Wendy Holding. My group is called the Sustainability Group, but it's a quarter of a larger family office of many families in Boston called Loring, Wolcott and Coolidge, which is an old trust company basically that's been around for a couple hundred years. It was founded when ship merchants were heading abroad and needed the trusted individual to look after their family affairs for a couple of years if they came back or when they came back. And about, almost 30 years ago, a woman named Amy Dominy came over to Loring, Wolcott and Coolidge and started what's now the Sustainability Group. So it's a quarter of the business. We manage about $1.25 billion. It's all for individuals and sometimes their foundations and some churches. And it's great to be here today. I think divestment is a really important and interesting conversation, but for me, it's sort of a gateway because I think I like that the publicity it's getting and the fact that it's making people think about the connection between the money they own as well as the money they're giving away. It's one part of a larger part, which is really what's your money doing and how's it impacting the world.
I'm Julie Goodrich, and I started a company 24 years ago called North Star Asset Management. We've never done any fossil fuel investing, and so I come by this from a very different perspective, I think. Portfolio manager, we work with individuals and nonprofits and stuff, doing socially responsible investing. One of the things that we did recently, I think it was last year or the year before actually, when this issue of divesting from fossil fuels came up, is that we wrote a paper based on another paper that had been written by an MIT professor. And this professor had been essentially saying that divestment from fossil fuels would be so costly that you had a fiduciary obligation to avoid divestment from fossil fuels. And actually we looked at all of his research and we looked at his numbers and we recalculated them and wrote a paper that indicated that using his same basic facts, that in fact the cost of divestment was minimal. And this is even with fossil fuels being a fairly large percentage of the Standard & Poor's 500 over a period of time. We went back 20 years and found out that the actual cost of divestment was about somewhere between 0.25% or to 0.5%. So we call that in the noise. So we found that there was absolutely no reason for people to even have fossil fuel companies in their portfolio, which of course made us feel better because we'd never had any. The only time we've had fossil fuels in our portfolio is when someone inherits them, which happens often. You know, people, you keep trying to get rid of ExxonMobil, and lo and behold, somebody comes up with some more shares, and you try to get rid of them. But at any rate, our goal has always been to have those companies out of there. And we have a broad understanding of what divestment from fossil fuel means, and we actually don't invest in any mining companies either. There are different ways to interpret what fossil fuel divestment means. 350.org has a list, and I actually have a handout here that I can give to you that supplies the name of 200 companies that they encourage you to divest from your portfolio. So I thought I would give you the list just so that you could bring it to your investment advisor if you have one. But the idea of divestment from fossil fuels is, you know, it's similar, like Eric was saying, to this whole concept of divesting from South Africa. And the question is, I think, just to sort of frame it, is what does it really do to divest from these companies? And hopefully we'll be touching on that a little bit as we go through this evening, because I have some particular views about it, and maybe different folks, especially Eric, I think, on this issue will have some views about that. We were asked this evening to lay out a couple of scenarios, to talk about specific scenarios of people who had issues with divestment, so that we could get to the nitty-gritty of how do you actually do this. So the idea is, because there's all this concern about climate change and the changing world, and this has obviously been going on for a really long time. We've been talking about issues around energy, use and abuse since the 70s. I'm sure many of you remember being in gas lines in the 1970s, trying to fill your car up with gas. I mean, it was an ugly time. It was this kind of burst of, solar energy and alternative energy started then. And then over the years, as oil prices have fluctuated, the interest in alternative energy has waxed and waned. Most recently, it's back, but a couple of years ago, it was doing, alternative energy stocks were doing incredibly badly.
To provide really more of that overview, the big picture, and then to see the different nuances, that are involved with it, the different components of both what socially responsible investing represents, and also then more finally, what does it mean, to be committed to divesting from fossil fuels?
So I'd love to go through some of my research, because these guys are much more seasoned and experienced in this area. I found my research fascinating because I had my perception. My perception was eliminate. So socially responsible investing is eliminate. Eliminate fossil fuels. It's value investing. What do you believe in? Eliminate fossil fuels, eliminate defense, eliminate tobacco, eliminate anything that just feels socially irresponsible. That was my perception, and we have done a little investing for clients in that space. What I found was, and Morgan Stanley is starting to really get into the framework of how do you both invest socially responsible and/or how do you make an impact while also making money, right? Because the challenge I always thought with socially responsible investing is that because it's the process of eliminating investments, that you're also eliminating your ability to perform. The way Morgan Stanley frames it up is they have 4 buckets. So value alignment, which is the social responsible investing, which is the elimination process of certain things that you don't believe in, the fossil fuels, the defense, the tobacco. Then there's another screening process, the environment, the ESG screening process, which I'm sure you guys are all really familiar with, right? So that's taking a look at, is a company, regardless of what they make or do, are they trying to make an impact in the environment? Are they trying to make an impact socially within their company? And are they trying to have governance policies that will guide their executive committee so that you put all of that together and hopefully it drives the performance? In this case, we're talking about publicly traded securities. So from my point of view, where I'm trying to help my clients protect and grow their money, I think of both. I think of what securities, what vehicles can I put my clients into where they can achieve everything. And so some of the early studies show that companies who are trying to do all three because they have that policy within their company, the environmental, the social, and the governance, actually have a chance of performing better because they're not getting into litigation because they're dumping waste, right? Or they're expanding their carbon footprint. They're making it an uncomfortable place to work, or they've got a chairman of the board who's also CEO and there's a conflict. So it just avoids a lot of costly mistakes. So that's a bucket. The other bucket in this framework would be sector exposure. So if you don't believe in fossil fuels, what next? Well, solar, wind, and so that you can actually buy publicly traded companies that can satisfy an alternative to fossil fuels. And then impact investing, which a lot of people don't have access to because typically private equity companies, they make a direct investment in trying to impact the environment. So I thought that was interesting because my perception was that I can't make my clients money just socially responsible investing, and clearly you can. So as a group, I looked at some of the ESG managers and some of what their holdings are, and some of the holdings are Royal Dutch, right? So here's the list. Sempra Energy, Suncor Energy, Schlumberger, which might not feel right, but they're meeting the ESG list. I thought that was really interesting because I never would have expected that some of these companies would be in this list. Now, there's many different ways to do it. So if your values say, I don't care that they meet the ESG screening, I don't want that company, right? We talked about that. So that's okay, because a socially responsible manager, their mandate is to invest socially responsible and find a way to grow the portfolio. I just thought that framework was a unique way to look at it, and I was a little surprised. And I feel like this is a good conversation for me now to start to have with my clients, where these guys have been doing it for a lot longer than me. So I thought that was interesting.
Taking off on what you just said, Jeff, I think the issue of social responsible investing, again, you all are familiar with it. But I want to focus a little bit more on the divestment side of it. Because of the fact, we've been doing SRI, all of us, for a long time. For me, the divestment campaign is a very natural evolution of social responsible investing. And and I really want to give thanks to Bill McKibben. I think Bill McKibben, the environmental activist, the writer, and even before that, Al Gore, by the way. Al Gore doesn't get enough credit. Think about the fact when he came out with An Inconvenient Truth, he helped to put out there the issue of global climate change, and Jim Hansen. And he even alluded to in his movie, he talked about what are the things you can do, lower your carbon footprint. He talked about those socially responsible investing as another way to address it, to help raise your consciousness about it. So I think that we owe Bill McKibben a tremendous debt of gratitude, and the young people. And I'm looking out here now, and I don't see the slew of young people because I've been doing a lot of events with 350.org throughout the state. And I'm very proud to say when we're doing these, half to three-quarters of the crowd are young people who have been driving this. They're the army that's putting this forward because very simply what they're saying is, if we continue to use fossil fuels the way that we're doing now, we're going to continue to warm up the environment, we're going to continue to add carbon. We're wrecking the environment. And as Bill says, and I love his line, what's the use of investing long-term for my retirement if we're not going to have an environment and an earth and a healthy earth to live on? I think that really is the core of the issue. So clearly my bias is beginning to show, which is, the history of social responsible investing was originally avoidances. You were talking about alcohol, tobacco, gambling. During the Vietnam War, we avoided defense contractors, we moved toward environmental issues, and then it grew to dealing with women's issues, and South Africa's in there. So this particular issue for me is so paramount that the time for shareholder activism and engagement, I think we've passed it. So I think to deal and to get the issue out there publicly, to help raise awareness, we need to take a serious look at how do you deal with fossil fuels in your portfolio and what they represent.
I work with individuals, and our portfolios tend to own about 30 stocks. That's it. And so I say that because it's in some ways easier for me to say what I'm going to say because I'm buying the companies, like maybe you are and I don't know, but I think maybe you're buying products, right? mutual funds, we're all going to have different ways of going about it based on whether we're buying individual companies or having to buy a mutual fund that is a pre-packaged product with stuff inside, right, a sausage kind of. Just to zoom out on socially responsible investing or applying standards to what you buy, I think the premise is that there's always this obsession about screening. Like you're saying, if you know, I live in a bubble, I live in Cambridge, I work with very liberal people, it all makes a lot of sense to me, but when I go down to Wall Street, I run into this reality again, which is that if you tell people you're applying standards to what you're buying, or if you're a socially responsible investor, they immediately write you off and say, oh, you're not buying tobacco stocks, there's got to be a performance give up, what's the cost? And that makes no sense to me, because anybody who's in the investment business is screening their portfolio in some way, right? International investors are only buying international stocks. Value investors are buying value stocks. Socially responsible investors are looking at the universe of names, and for me, I don't really care what Philip Morris is doing. It's not in my, it's not what I think is going to be the big growth driver. So whether I buy tobacco or not is irrelevant. What we're looking at is, where do we want the world to go, and what are the companies that are going to be helping make that happen or benefiting from various sustainability themes. And so that's the one part of it. Okay, that's so it's proactively trying to buy companies that you think are doing good for the world, or looking at all the same financials that every other. The investment business is a game of information, right? So we're looking at the same financials everyone else is looking at, but we're also looking at these other factors, these non-financial factors called environmental, social, and governance factors that are giving us a little bit of a different story about the company. So for example, when I first started in this business, it was right when BP was doing their Crazy Beyond Petroleum campaign. And so I would go to a cocktail party and they'd say, oh great, you're doing socially responsible investing, do you buy BP? And I'd say, no. I'm not buying BP, it's a joke, it's total greenwashing, it's such a small fraction what they're doing in alternatives compared to the big oil beast. And by the way, they have a terrible health and safety record. Lo and behold, a few years later, you know what happened. And if you just looked at the financials of BP, you would be thinking, great assets, cheap stock, high dividend, woohoo, this is a great company to buy. They must be doing, Beyond Petroleum, isn't this a home run? We're just looking at a little bit extra data that a lot more people are now beginning to look at, which is telling us something about what's happening in a company. So if you have a management team that's contemplating not just what their environmental, a lot of people lock onto the risk, and that is fair, environmental risk, but it's not just, it's what impact are we having on the environment, what impact are we having on the community, how happy are our employees, what are the risks in our supply chain? Doesn't that make sense that management team is a little bit more forward-looking, and that company might be a little bit better managed? So if you've got two companies and one management team is thinking about this and one management team isn't, why wouldn't you want to invest in the company that is thinking about it? And doesn't it make sense that company might do a little better? And I think there's a lot of numbers that say that is the case. So that's that's what I do, right? It's only 30 companies. So setting that stage, and there's another part, because I'm sitting next to the queen of shareholder advocacy over here.
She and I were both trained by the same person, essentially,
Yeah.
Amy Dominy. And Amy Dominy wrote a book in 1984 called Ethical Investing. And so that day, when I was a stockbroker at E.F. Hutton, I called up Amy Dominy and I said, I need to know you and we need to do things together. And so we started teaching classes at Cambridge Center for Adult Ed. So we have the same kind of background. And so what I've noticed with socially responsible investing or ethical investing is that over the years, my sense that I'm creating change, I hit what I call the bullshit meter. So for example, we're avoiding these stocks, not enough, that's bullshit. We're buying interesting companies, okay, that's okay, well that seems pretty good. No, that's bullshit, because they really aren't doing the great things that they say that they're doing. I mean, all companies have things about them that are, and I wouldn't say all companies, all socially responsible companies that would be on our list of companies we'd be interested in investing in, have things about them that are compelling and things that you might want to invest in, just like what Wendy's talking about. Unfortunately, they also, every single one of those companies has something awful about it. We too, some of our competitors or whatever in doing money management actually have the companies in the portfolio that were pointed out earlier. things like BP, things like Schlumberger, these kinds of companies exist in some socially responsible portfolios. So at North Star, we do this other thing. We have about 45 to 50 stocks in our portfolio. So we're using all the same kind of criteria that they're using at Loring Wolcott to limit our universe a little bit, but we're looking at these fundamental issues for these companies. Why do we want to invest in them? What industry are they in? Why do we want to be in that industry? What's the point? You know, what are we hoping to get? Is this the best actor in that industry? And we do that internationally. But the other thing we do is we say, but it's not enough to own shares of Intel. If Intel, for example, which is really great on a whole lot of ways, is sucking all the water out of southern Arizona to be able to wash its chips, that's a problem. So we have to engage with that company. And so we do shareholder activism. And that's a huge part of what we do. Part of my problem with this whole concept of divestment from fossil fuels is that ExxonMobil, BP, nobody cares. They do not care if you sell your shares. I mean, part of the reason why, as Eric was saying, shareholder activism does not work in the fossil fuel industry is because you go to an ExxonMobil shareholder meeting, as I've done maybe 10 times, because I had a client who had a few shares of ExxonMobil. They do not care, you know, and as Wendy pointed out, BP, you know, it has this teeny little bit of money that they're using to do, you know, sort of alternative energy things. It's talk about a bullshit meter. So what do? I mean, what we do is we just don't bother with those people. You know, we don't bother. But I think that there's a problem, and we don't need to get into that right now, but I think that there's a problem about this concept of divestment. You do not need to have these companies in your portfolio, but divesting from these companies is not going to make any difference whatsoever. And that is something that you really need to understand. The question is, and this is back to what Amy Dominy used to say, the question is, do you want to profit from these companies in your portfolio? Do you want to profit from the mutual fund that's sitting in your portfolio that has an energy sector component that has these 27 companies in it, all of which are reprehensible? Is that something you want to profit from? And so those are the kinds of questions you need to ask yourself. This whole divestment from fossil fuels, you know, these companies are going to do just fine without us, okay? But I do think that there's something really important about investors like yourselves taking a stand and finally saying, look, I'm going to take some ownership over my finances. I don't want to profit from this stuff. And so let me figure out a way to craft my portfolio that will make me feel, you know, like it is representative of who I am. Amy Dominy, again, used to say, and when we taught our classes, and this is back in the old days, okay, so she'd say if somebody found your checkbook lying on the street and they looked at all the places you'd been writing checks out to, what would they learn about who you are as a person? And the same thing holds true from your portfolio. If you look at all of the investments in your portfolio, does that represent your values and who you are?
Let me add an interesting perspective, and I think it contrasts the way that both of you manage money. Okay, there are different ways that we manage money as investment advisors. Julie, you know, your group, they're picking universes of 30, 40, 50 stocks. Okay, our model that we do is very different. Our clients come to us and we design portfolios that are using socially responsible mutual funds that are already out there. Names that you're going to know. And again, I can't recommend anything because I don't know any of you, but I'm just going to broadly say them because you know them. You know, like a Calver, Dominy, Parnassus, Paxful. There's a lot of them. You have community investing. Okay. There's an interesting dilemma now that separates the challenge that I have on behalf of my clients, because most people who invest, right, in your retirement plans and your IRAs usually do not just have a portfolio of 30 or 50 stocks. If you're a small investor, 50, even 100,000 or a few 100,000, it's very likely you have a range of mutual funds. So here's a dilemma you're faced with. If you take a look at the holdings in your mutual fund, you know, when you go to Yahoo Finance, this or Morningstar, take a look at your top 25 or 50. It's a large company mutual fund. Guaranteed you're going to see energy in there. And here's a question for the group. Out of the S&P 500, what percentage is in fossil fuel companies? Let me get some guesses from out here. Let's see, folks. 20%? How about some other guesses?
15.
15?
I'll say 10 just to
Okay,
round it
it's
out.
right around 10, 11%.
Yeah.
Okay. So what happens is in your typical large cap mutual fund, it's not uncommon to see 5%, 7%, 10% plus more. If you have the S&P 500, which a lot of people do, right? A lot of people have an S&P 500 fund, you know you're getting it. So here's a dilemma for any individual investor like yourself, which is, you look at what your funds own, what are you going to do about it? Well, you have two options, right? You can say, well, I'm not happy about it, but I'm going to hold it. Or you basically make a conscious decision to sell the mutual funds or the exchange-traded funds. Are you all familiar with what an exchange-traded fund is, an ETF? All right, let me give a very
I
quick...
know a mutual fund, but
Right,
not the
mutual.
other.
An exchange-traded fund is a basket of stocks
Mhm.
that has a certain theme. You can have large cap, mid cap, small cap. You can have solar, wind, energy efficiency, China, India, but so with a focus, and it trades all day long in the New York Stock Exchange. Okay, so a typical investor, because that's my client. My client is your typical investor who could have anywhere from 25 to several hundred thousand to a few million dollars. Okay, so we're using these, we'll call them package investments, mutual funds or ETFs, and the clients will say to us, Eric, try to have them holding companies that avoid reprehensible companies, as we've spoken about, and now particularly avoiding companies that are involved with fossil fuels. But it's a challenge for a typical investor, because you'll need to do some research and some due diligence, and you're going to find them in there. And one of the interesting conversation now that is coming up within the SRI community is dealing with natural gas. And that is, you know, right, as we all know, natural gas was, right, the bridge fuel to the future. Smallest the carbon footprint. And that's true. But fracking is a game changer. I think most of you are aware of fracking, the serious environmental issues, dealing with water usage, health-related issues, what's been happening in Bakken, the Marcellus Shale. So there's a very interesting conversation within the SRI community that kind of relates to the perspective that you and I have, Julie, which is shareholder activism versus. And there is, what I'm going to contend, there's a need and a role for both tacks in many areas. Engagement, activism, and divestment, because they're tools, right? They're tools to help raise awareness about what are the corporate practices of these companies. And the reason we're here is because we care, right? We're here not just because we want to make money, we want to grow our investments, but we want to do it in a way that's aligned with our values, our principles, our concerns, not just for us, you know, but for my daughter, the grandchildren, right? So I think you've got to balance these issues on there. So the good news is, you know, there are a whole range of investments out there that are both socially, environmentally screened, that say avoid fossil fuels. Then there's a whole range of other investments out there that we'll call niche investments, you know, that are in sectors that just don't have any exposure. So you can begin to build a portfolio if you're an individual investor, picking mutual funds you feel you'd be comfortable with. You can pick some individual stocks, or you can pick ETFs. So I just want to add that perspective, you know, as we're trying to take a look at concrete steps that an individual investor can do in their own. Retirement plans are a whole different beast because you don't have control to what mutual funds you can use, you know, you can invest in. You know, that you have your set universe, and that's what you get to pick.
And so there is a whole universe now. I mean, so
Yeah.
there was $100 billion in socially responsible mutual funds in 2005. Now there's like $650 billion. So it continues to grow. And a company like Morgan Stanley, who all of a sudden is starting to not only work on their own internal governance, but they're giving us the platform. So our clients are 3 to 10 million, right? That's about our range. So they have access to a broader set of investments where they can get more precise. Separately managed accounts, you know, individual stocks. We don't do a lot of individual stocks, but that's certainly the most precise way that you can do it. And I've typically asked clients, you know, are there any restrictions you have? Knowing full well there's investments that I have that we're going to use in order to build out a portfolio that in the S&P 500, in the Russell, anything that we use, inevitably in there are things that if they tell me they want to restrict some things, and a lot of times what you guys, I don't know, if you'd be surprised or not, but what doesn't come up is, I don't want any fossil fuels, I don't want any, defense
yet.
contract.
Not yet.
What comes up, I don't want any banks, right? So I very, very rarely do I get I want no natural gas, or MLPs in my portfolio. So, but I feel empowered now. I'm gonna start asking more of the question, more of, here's some other subsets to think about, because there are ways to do it. So separately managed accounts, a separately managed account is, a mutual fund is a pool of assets, and you just own units of that pool. So you don't truly own the individual components. But with a separately managed account, it's also a money manager who's buying the same securities for each person who owns that separately managed account or money manager. So you truly own the stocks, you own the securities. So if you open up your account, you can see the 37 holdings that the manager has. That's a great place to say, I don't want the following. Now, within reason, because you can't also handcuff the manager, but that's where you can say, in these separately managed accounts, the minimums are 100 to 250. You can tell the manager, I don't want fossil fuel, I don't want natural gas. You can name the companies that you want. So that's another way to get a little bit more precise in expressing your values in a portfolio. But again, the big challenge, and there's a way to get around it, is diversifying. You still want to make sure that the portfolio not only reflects your values, but it still has to work. But with socially responsible investing and the big subset of the access that we now have, because there's so many more managers online, there is a way to do it. And you're right. So these managers who are following governance policies within the company, they actually have a better chance to perform because they're avoiding some of the things that can hurt them, the liabilities, the lawsuits, some of the things that can cost them money because of waste. It's certainly becoming more mainstream, and I had my perceptions earlier, and I feel so much better about it.
First of all, the whole notion of does a company care or not care, or is it important whether you are or aren't invested, I think that that's sort of generally true. I mean, whether you buy a great company, no company really, it doesn't affect them whether you buy or sell their stock. But what does affect them is the sort of the moral hazard element. And this is all coming back to why are we sitting here? Why is divestment important? In the same way that you had financial analysts requesting sort of standard accounting to be able to measure different companies, socially responsible investors year after year after year were asking all of these companies for information about environmental, social performance. And without people asking those questions, there would never have been this body. What you're talking about now is that it's almost so much harder to do what we're doing now because we're virtually flooded with information about what great corporate citizens these companies are. And we have to go through and with a fine knife and figure out what is real here or what isn't, and how do you compare this company to that company if they're reporting so differently. But the great part about that is that with all this information comes and young people, more informed consumers, people actually care about, what kind of corporate citizen their, companies are. That's why you've even had VPs coming out saying that they're so green. And so I think companies want to be perceived as doing good for the world, which is why this divestment movement is really important, I think. I mean, you have Exxon now coming out, there's all this talk about and what will happen. Will we have a carbon tax? Have you heard about these stranded assets, essentially, which is basically, all of these exploration and production companies are valued on constantly exploring and having more and more assets and saying, finding and getting all those things out of the ground. But if something happens where we say, supposedly if everyone burned all of their assets that they have, the world would be warmed 5 times over. So there's this whole notion that, how valuable are these fossil fuel companies if they can never even access these assets that they have to burn them because we can't, because the world will melt, So then it forces the hand. Then you have Exxon coming out and actually saying, we hear what you're saying, but we're not worried about it. Legislation will never change. We're going to still doing what we're doing and go away, basically. So these conversations. So back
That's
to
totally. Let me just say something. So that is completely, totally true. So when I say that ExxonMobil doesn't care if you divest your shares, this groundswell of attention that you all are creating and that, is hugely important in terms of raising the level of awareness of what it is that these companies are doing, such that then they're not just going to be responsible to stakeholders, but potentially stakeholders, shareholders, or non-shareholders, just citizens, are going to go and talk to their local government and say, hey, you know, these things are really scary to us, we don't value these things. And then you will see a shift in tax status for these corporations. Things that were usually underwritten and tax breaks that were given will be taken away. I mean, there is sort of a movement building quality that is important.
I'd like to share some important quotes in regards to this issue of global climate change and investing. Okay? I was with a panel of folks from 350.org that had a meeting with the Deputy Treasurer of the state of Massachusetts, Steve Grossman, who's taken a very public stance on this, by the way, to the credit of Steve Grossman. Steve Grossman today joined a group of 70 other large investors in calling on 45 of the world's largest oil and gas companies to assess the financial risk that global climate change poses. By joining together and combining our voices, we're sending a clear and powerful message to the fossil fuel industries as investors. We not only want strong shareholder value, but also responsible environmental practices, says Grossman. Given the trend toward a low-carbon future, these companies need to assess their long-term goals in the interests of ongoing sustainability and profitability. Okay, this is representative of what's beginning to happen now throughout the country. Another quote that I'd like to share, and this comes from the World Bank president, Mr. Kim. This was coming from January when they were, I believe, at Davos. He goes on to say, this is a year to take action on climate change. There are no more excuses. If we fail, our children and grandchildren will ask us why we didn't act when it was still possible to do so. We need leaders who are not thinking about short-term returns or election cycles. We need leaders who are thinking foremost about taking care of the most vulnerable in this generation, the generation ahead. The good news is that there is an action we can all take to turn economies around so they're investing, and this is what we all agree on, clean and healthy innovations that will bring future growth, jobs, and competitiveness. Now, this is really key. Through policy reforms, we can divest and tax that which we don't want, the carbon that threatens development gains of the last 20 years. This is the head of the World Bank.
So basically what you need to understand is you have to look at your portfolio and figure out if you have individual stocks in your portfolio, if you have mutual funds in your portfolio. If you have mutual funds in your portfolio, you need to they will have, unless they're sort of one of 5 different mutual funds, I think there are 4 or 5, I have a list of them here, that don't do fossil fuel investing. In most cases, you will have fossil fuel investments in your mutual fund. So you probably should bring your concerns to your investment advisor and say, I'm not interested in this, what do I do? If you have individual stocks in your portfolio, it's a little bit easier because you can go through, as everybody said, and you could say, all right, I don't want this in there, maybe I should get it out. Then what you have to worry about is you have to worry about tax considerations. So what does it cost to get out of this thing? You're in some Fidelity mutual fund, it's all, it's got all these fossil fuel investments, it's gonna, you have a cost basis of $10,000, it's worth $25,000. What does it mean for you to sell all those shares? And is that a worthwhile thing? So that is a tax consideration. You have to figure out whether or not you can really afford to do that right now, or whether you could take, an approach over a certain number of years where I'm going to divest of these over a long period of time, and in the meantime, you could write to the manager of that fund and request that they divest so that you don't have to, right? The other thing is with individual stocks, you've got the same problem. I got clients with, maybe a client with ExxonMobil with $1 a share cost basis, that creates a tax problem. When they go to sell it, they have a capital gain. What kind of a risk is that going to do? What kind of situation are you going to be in? If it's in a retirement account, none of these things, that's tax sheltered, so you won't have to worry about it. And then what you have to worry, the one thing you can do if you have individual stocks, or even if you have just a few shares of a mutual fund, and you do charitable giving every year, you could gift shares of your stocks that you don't like anymore, or your mutual fund that you don't really want to own shares of anymore. And you can say, all right, I'm giving this money to the UU Church in, Marblehead, and I'm gonna usually give them $1,000. I'm gonna give them $1,000 worth of the Fidelity Magellan Fund, and that'll be, the way that I'll chip away at this over a long period of time.
And then they have to deal with it.
And they'll just sell it, and everything will be fine.
Right.
So that's kind of what you have to do. So you can say, all right, I'm gonna sell this, and I'm gonna go into one of these 4 mutual funds that exist that don't do fossil fuel investment. This is from the 350.org website. So I have no idea. First of all, 2 of the funds are fixed income funds.
The great thing about you being here and having managers here is that by requesting it, the products get made. So
Right.
already, there's going to be an ETF that's going to be launched that's fossil fuel. So it's more and more, and it's happening. It's happening on the local level. It's happening on the institutional level. And that, that back to sort of Bill McKibben and 350.org and the students. I mean, this may not seem like a big deal, and is it or isn't it? But the fact that Harvard Management Company, which is the body that manages Harvard's endowment, they hired a sustainability officer last fall, and that was a big whoopla. And symbolically it is, because everyone watches what they're doing, and whether this person will, but now they're having the conversations with their managers about what's going to happen, because there's so much pressure being created from the students, and so it's a really important thing that's happening, and you'll see more products that come out of that.
So you have a Trillium portfolio, and you can see from looking at your Trillium portfolio that there are problematic companies in there. So you need to speak to them about that and say, I don't want to be in these problematic companies. They've developed a product, all these bigger money management companies develop these products to solve these kinds of problems.
Yeah.
So, or you could simply say, get rid of those stocks out of my portfolio in some way that's not going to, screw me financially.
And assuming that, so are they separately managed accounts? They're not in the mutual fund, I'm not familiar.
No, it's a separately.
So you should be able, like we discussed, you should be able to set your restrictions.
Right.
So, in spite of the fact that they're gonna say, it meets our screening process, you're gonna say, okay, our values-based approach says we don't want those. And, they can put those restrictions on there, so they can customize it to you.
And that Trillium portfolio, because I know the manager sat in his panels with her, I'm really pleased and proud to tell you, it's their fastest growing portfolio. Money is flooding in to the Trillium portfolio that avoids fossil fuel. It's their fastest growing portfolio of separately managed accounts. And I think it's a reflection on the growing awareness of this issue. So there's an example of that there.
My understanding, and I may be wrong, is that Trillium deliberately owns some of these energy funds so that they can actively work with the management to limit their contamination, whatever you want us to call it. But they're working within the companies, so they own the stock for that purpose.
We do the same kind of shareholder activism that they do, but we don't own the stocks. And I think what Wendy's saying is accurate, which is that they're saying, okay, if 11% of the Standard & Poor's 500 is energy, then we're going to have some energy companies in the portfolio. Let's try to pick the companies that we think are the best players in that field.
There's bottom-up stock pickers and there's sort of top-down. And the top-down being, if you're benchmarked against the S&P 500 and it's 10% energy, just like, we'll own 10% energy, or we'll own 3% of materials. So they'll own all of the sectors, and then they just, I don't want to speak for Trillium, I don't know well what they do, but.
That's what they do. We do the same thing. We benchmark and we do a top-down approach, which is we say, okay, we want this percentage in, consumer staple companies and this percentage in consumer cyclical companies and that kind of thing. And then we figure out what ones we're going to go into, but we avoid energy.
Yeah.
We just say, forget it.
people
We
do
don't
it
even like financial
differently.
companies.
I've not found any place where any stockholder resolution or activism or talking or anything has basically had any of the actual companies that hold the fuel say, okay, we agree, we're going to stop looking for more of that, and we're going to start moving that more toward, alternative energy sources. I've not been able to find anything. I found some like Valero, who doesn't produce, saying, okay, we're going to reduce our own carbon footprint internally, but I've not found anybody else.
I think that that's really right. And I think that that points to why maybe the Trillium strategy, we have to, when there are rules around how to do shareholder engagement as a shareholder, okay? And you're not allowed to comment on ordinary business. And so we can go in, you know, Greenpeace is a client of mine and has been for many years, and they can go in and do an action at an ExxonMobil shareholder meeting and make a big stink, but they can't necessarily attack their business practices, their business, the way that they do business, their profitability. You have to be very careful. Now, why someone, you know, there have been plenty of shareholder activists like Trillium that have gone in and said, I would like you to give me a report on the cost of, you know, switching over from this to this or whatever. And even that type of thing, you know, you can run into problems getting that resolution before the shareholders, because it can be considered ordinary business. So it's kind of tricky. And then the question is, and I think this is why this whole, you know, divestment movement happened, is, you know, if you can't craft a shareholder resolution necessarily that's going to get to the root cause of the problem, because their number one top priority is to sell you oil, you know, then what is your alternative? And your alternative then becomes divestment.
They're not going to change their business model.
There's nothing that anybody
Right.
could do from inside that would have.
And I
to
think
basically
that's
change that.
one of the
Okay.
compelling arguments on here that we hear from different quarters. South Africa was successful. Remember, it started with engagement, and then it was divestment. But very simply, what were we asking? We were asking American companies to sell their subsidiaries doing business there, right? GM, IBM, Dell. That was fairly simple. What we're asking fossil fuel companies to take a very hard look at is their business model. We're saying to them, we want you to change your business model. Because if you continue to look for reserves, if you continue to extract them, you continue to sell them, we're going to be adding to global climate change. And that's a real problem. When you're a shareholder of ExxonMobil or Chevron or BP, you want your company to be as profitable as possible. We have to look at this entire paradigm of saying, if you want to change that model, then it's not realistic to think that the shareholders of fossil fuel companies are going to agree.
I think that the 350.org model will have, you know, will end up with enough of a groundswell, like you were talking about, like I said before, of a, you know, public citizen saying, we don't like this, you know, and then that'll turn into discussions around government behavior and tax incentives and that kind of thing, which will put pressure on these companies. But I don't think that there's a direct connection between, you know, these companies and livelihood and oppressive regime. I mean, there just isn't. It's a very different kind of thing, although divestment is a reasonable alternative at this point.
You know, you're asking for a company like ExxonMobil, which is a $300 billion market cap. That's a big ship to move. And you're asking shareholders to, I mean, to think where they'd have to go to change that. And so you're asking shareholders to be wiped out is divestiture, right? So that, and the lobbyists are, I mean, they're some of the strongest. So we can do what we can do, and it's about values-based investing. And it's kind of sad to think what ultimately might happen because of it, but it's just a big animal.
It'd be interesting though, you know, I just thought of something, what if there was enough pressure from large institutional shareholders to divest that they said, okay, we're gonna sell at, you know, the largest company in the S&P, we're gonna sell it so that it's not in there anymore, and then the S&P might say, well, we're not gonna have it in the S&P anymore, and then it would be out of ETFs. So exchange traded funds that are essentially trying to mimic the Standard & Poor's 500 wouldn't have to have Exxon in there anymore.
So if
I mean,
everybody's
that could be-
sold, the company goes to zero.
The company
they're
goes
done.
down in value.
There,
But I
it's
mean,
game
like-
over. It doesn't, game over. It doesn't matter what their assets are, you know, in the ground or, you know, these hidden assets, it's game over.
The difference, as I'm hearing it, is that there's between withdrawing from a country like South Africa, our various companies, is very different from asking Exxon and Mobil to disband as a corporation.
Yeah.
It is, it's a different battle. It's a
Yeah.
very different conversation.
It's different because they live in the, we live, this is a capitalist society, it's a free,
Yeah.
they live in the capital structure of the United States.
So you're asking us to destroy our own economy, not South Africa's.
Right, yeah.
Or the world's
The world's,
economy.
the
Or
world's, the
World
world's.
economy,
right,
but, yeah,
right.
but what I'm saying is that when we as activists, because I was around then, advocated for disbanding from South Africa, or withdrawing from South Africa, we were asking to hurt their economy so they would shape up. What we're saying, what I'm getting is if we're asking people to totally withdraw from Exxon, we're the ones who ultimately would suffer the consequences.
I sit on the board of a couple of sort of social change kinds of organizations, and one of the things that's been really hard, and did you see Inequality for All with the Robert Reich movie? I highly recommend it, it's on Netflix. Basically, he talks about, the huge wealth divide in this country. And what I see this 350.org movement around divestment from fossil fuels to be is another model, organizing model, so that you can create a massive movement of people who are concerned about an issue that will ultimately build a base of support around, values, right? Whether it's about, climate change, or it could be about anything. But you're building a base, and when you build a base, that has a positive benefit on movements in general. And one of the things that's been problematic is that we have not, as a country, been fighting back around different taxation changes since Jimmy Carter was president. We have not been doing the work as a people to make sure that the middle class remains the middle class. We've watched as unions get torn up and, people lose pension benefits, and all this kind of stuff has been going on. So there is a component of this that I can see as a part of a greater social movement that might be very, very important going into the future, whether it's around climate change or it's around, any issues around, a living wage. And that, to me, is reason enough to join the masses and take part in this.
There was an article in the current New Yorker magazine talking about how people haven't been doing anything, they've been sitting around since the 70s.
Correct.
But one of the things is that there's so many ways to approach this, that divesting is an important part of it, but carbon tax, et cetera. So to what you're saying, what I've been thinking is I'm really hoping it becomes larger, and the divestment becomes a much larger conversation.
If there becomes some viable alternatives, and it becomes more of, a way of life change, then these companies should shrink some. I mean, that's the ultimate goal, right? You should start to shrink these companies. They start to shut down oil fields because it's not as profitable anymore. There's a point at which they're not making money on a barrel of oil, so they're going to have to start to dilute themselves somewhat. I don't know what that is. We're trying a lot of things: solar, wind, electric, inevitably electric. At the end station is powered by gas or something. But I think a change in just the way we do things should ultimately, hopefully, start to help. Which is why I just thought the ESG, the environmental, social, and governance screening process, where all companies are starting to think in this direction, has got to help. And I know that China has some real environmental issues, and they're probably adding massively to the problem, and hopefully at some point they come online. But I think as a country we're starting, we're aware of it now.
Yeah.
It's in, it's just in our face all the time. So the question is, the U.S. citizens not being lazy and actually doing something about it and mobilizing in any form.
My sense from reading is that if one of the arguments for not divesting is, oh my God, you're going to give up some of the return or some of the value in your portfolio, my sense is that with things like where solar's taking off and all these, there are other alternative energy stocks or portfolios that you could buy that you get the same kind of return or better.
No, it's apples and oranges. Solar stocks and those kinds of things can be, can be wildly volatile. And so, as opposed to a dividend-paying oil company. The study that we did involved taking oil and gas, any kind of fossil fuel companies, completely out of a portfolio. We didn't substitute, occasionally we'll substitute, so you don't need to substitute anything in.
it's a really exciting time. There's a ground shift happening. I mean, there's this awareness about, at some point, we're gonna have a carbon tax. I mean, Bangladesh is gonna go underwater. I mean, the world is gonna, there's gonna be a revolution, or there should be. There's a lot happening on the energy efficiency side that's more stable. I mean, you think about, look what just happened with the Empire State Building. Johnson Controls came in there and they retrofitted the whole building, put in all of these, made it very energy efficient, and then sold it for twice as much. So there's companies doing very interesting stuff around energy efficiency. This thing that's happening with solar, I mean, this thing came out the other day where there was on-the-grid solar in Texas for 5 cents a kilowatt hour, which is like as cheap as coal. And I think, you have to think when I think about these things in terms of investments, having invested at one point in 2005, we bought natural gas, solar, and wind, and we got clobbered. And you have to think, to whom do the benefits accrue when you're looking at a company to invest in? So the very thing that's making solar so widely adoptable right now is that the prices are dropping hugely, thanks mostly to China. And so you don't want to buy a company whose product is getting cheaper and cheaper and cheaper. It's great for the world because that means solar panels are popping up everywhere, right? So you're probably not going to buy the panel maker, but there are other ways maybe that you can benefit from that. So you just have to think about it that way. So I'm sort of echoing what she's saying. It's just, with these, they're sort of sexy, like the latest, greatest technology, but the technology might not work. The government subsidies might dry up, as they constantly do in the US and now over the rest of the world. So you have to be a little bit careful. If you're hell-bent, as some of my clients are, on going into that kind of stuff, then make sure you buy a basket that's well diversified, because it's almost, think about it almost like a venture capital pool, where the way those guys invest, they're investing in 10 things hoping one will make it and the others will probably fail.
I agree. So you don't have to have energy in a portfolio, fossil fuels, to perform. There's so many other ways to do it. It's not necessary. You don't need a replacement.
I essentially agree, but I'm going to give you another perspective, which is people often will say, okay, I'm going to sell my fossil fuel companies, and what am I going to do with those dollars? So I'll just lay out a hypothetical. Let's say you had $1,000 invested in S&P 500 fund, okay? And you said, let's divest it, and now we have $100 to place somewhere. Where we're in agreement here is a portfolio manager has all these different sectors, and what we want to try to do is to capture the alpha or the performance characteristics of energy, we'll say. So with the way that we do it, and the way that's talked about from 350.org, is to divest and reinvest. And here are some of the related areas where you can capture energy alpha, things like energy efficiency and conservation. You might want to have some exposure to wind, some to solar, maybe geothermal, rebuilding infrastructure, water utilities. Think of it in the context as taking those dollars that would go into pure fossil fuels, reinvesting it into areas that are related to energy, but are related to energy in a more sustainable, more impactful area.
Be vocal about it. Don't just
Yeah.
sell your stock and go away.
Right.
Plaster it across the headlines.
Right.
And
Right.
join the groundswell and show up at these meetings and join the students and write letters.
I know the UU has a common endowment fund. There's been a lot of conversation, as you know, in that, whether they're going to be divesting or not. And I believe that at the General Assembly in Louisville, Kentucky, they voted to be studying the issue, and then they're going to be voting on it, I believe, to implement it in Providence. And we've seen quite a few UU churches, have voted to divest.
Yes.
And I think they're doing it on a church-by-church basis. And I think what we would suggest is let each church have a conversation, a dialogue, within the congregates, right?
Thank you very much. I
Thank you all
appreciate
for
this. Thank
being here.